Welcome to Tekedia Daily. I'm Ndubuisi Ekekwe. Our conversation today will focus on beyond cost to income ratio in the Nigerian digital banking and fintech sectors. So essentially, we'll be looking at the whole construct of building scalable digital financial products and services within the Nigerian ecosystem. One of the most cardinal important ratios in the banking industry is what they call the cost to income ratio. The cost to income ratio basically gives you a very good understanding of how a banking institution is actually utilizing its assets in creating value. So when that number goes very, very low, it means that the efficiency in the utilization of capital is actually very high. It means that you are using less resources in order for you to actually generate more income. So it's basically an equation. The numerator is the cost. The denominator is the income. So there are really two ways for you to play that game. You have to reduce the numerator. That means you have to reduce the cost for you to basically have the cost to income ratio to go low. Or you can increase significantly the income for the cost to income ratio to go low. But I'm trying to explain here that even the whole construct of reducing the cost to income ratio may not be enough. As we begin to transition into the digital domain, where the future banking will take place, a lot of things will happen. I am seeing a future where the new basis of competition will be formed. What I mean by the new basis of competition is like it is not just moving the cost to income ratio from 60% to 45% or maybe to 30% or whatever. It is that you can even get into a scenario where the cost to income ratio practically gets to a zero. You may say, how can it be? Because a company must always have cost. Yes, a company must always have cost if you operate in a traditional banking institution. But if you know one thing, that in a perfect internet business, the marginal cost usually tends to zero because the cost of acquisition of an extra customer must necessarily go to zero for you to have the capacity to develop a scalable advantage. Because if you do not have that ability to develop a scalable advantage, it means that you cannot scale. And this is a business where, because the internet itself is so unbounded with multiple layers of distribution channels, the competition is high. So everyone is running down who is going to deliver that service at the least possible cost. And that becomes a very big issue. So your cost has to go low for you to have an opportunity to compete. It could be in your payment system, it could be in your lending system, it could be even in your remittance system. Because the issue here, just on a Google search, people can make comparisons of the best possible product in the market. Before the age of Google, airlines were charging people more, not necessarily because they needed to charge people more. Rather, they could just charge people more because there was no way people could know, because there was an information asymmetry. It's very, very difficult for you to go to Nigerian Airways, and then if Nigerian Airways was not, you didn't like it, you go to maybe another airline, let's say Aero, and then you go to Aero, say, hey, Aero is not doing well, let me go to Arik. I promise you, by the time you go to 2-3 airlines, you just give up. But in the age of internet, you don't even need to step out. You could make those comparisons to largely as many airlines as possible, and you know the one that gives you the best cost. The same thing will happen in digital products. You could figure out the best possible one without necessarily stepping out of your house. And that is the age we are going into. So for you to compete, the marginal cost has to go low. And even the fact that the marginal cost goes too low, it typically means that your product has to be priced very, very affordably. And you can't just do anything about it because we are entering a new age where the dawn of cost to income ratio of 40%, 30% as being held as category leading in the Nigerian banking sector is going to systematically move to a moment when the cost to income ratio has to go below 10%. A company called Circle, founded and supported by Goldman Sachs, now enables US citizens, people living in the United States, to send money, international remittance to United Kingdom and the whole broad European Union at absolutely zero fee. In other words, you want to send money from New York to London. It doesn't cost you anything. It doesn't cost you anything. So this is actually the final phase of the evolutionary process of the internet. Because at the first phase, we had the ICT giving us productivity gain. And then the internet gave us unbounded distribution channels. The blockchain, a new technology that basically powers the Bitcoin. I'm not necessarily interested in the Bitcoin element, but I'm interested in the blockchain. Is what is going to make it possible that more services delivered on the web will tend towards zero. And that is going to be a big deal because you may not necessarily have a reason to charge if other people are making it free. And that means when these services become very, very low or get towards zero, that cost to income ratio may actually have to be below 10%. This is going to be the new future of digital bank. This is going to be what the fintechs have to deal with. It's not just in remittance, it has to happen in payments. It also have to just move from payment even to lending. Indeed, in all areas of banking operations, we need to see a new evolution. And people that are going to play in this role will change the basis of competition. Because when they change the basis of competition, they are bringing an entirely different banking architecture that will make what we have today to be primitive. And if the banks or the fintechs that we have today cannot evolve into that new future, where we are looking at that marginal cost remaining low as the cost to income ratio becoming sub 10%, they may not have an opportunity to compete. You are listening to Tekedia.